Welcome to the Ultimate Forex Trading Course by Saheed Pressi Part 2. Module 4, Risk Management. Risk management is essential in Forex trading, as it allows traders to safeguard their capital, maintain long-term stability, and maximize potential returns. This module empowers traders with practical strategies to balance risks and rewards effectively. Implement effective risk management strategies. Managing risk isn't just about avoiding losses, it's about consistently making choices that align with your overall strategy. In this section, you'll explore core strategies to ensure every trade fits within your risk tolerance. Setting stop loss and take profit orders. 1. Stop loss orders. These are automated instructions to exit a trade at a predetermined price to limit potential losses. Setting an appropriate stop loss can prevent you from losing more than you're willing to risk. 2. Take profit orders. These are automated instructions to close a trade when it reaches a certain profit level. By locking in gains, you prevent emotions from affecting your decision to exit a profitable position. Diversification. 1. Diversification reduces risk by spreading investments across different currency pairs. By diversifying, you avoid putting all your capital in one trade or currency, which can protect you if one currency experiences sudden volatility. Risk-reward ratio. 1. This ratio helps you compare the potential reward of a trade to the risk involved. For example, a 2-to-1 risk-reward ratio means that for every dollar you risk, you aim to earn 2. Aiming for favorable ratios, for example, 2-to-1 or 3-to-1, increases the likelihood that profitable trades will outweigh losses over time. Risk per trade. Calculate position sizing and leverage. Position sizing and leverage are critical to managing your exposure to the market. Mismanaging these aspects can lead to significant losses, especially when using high leverage. Position sizing. 1. Calculating position size is about determining how much of your account you're putting at risk. Position size depends on your account size, risk per trade, and stop loss distance. By understanding and adjusting position size, you control the amount of risk you take on each trade. Leverage. 1. Leverage allows you to control a larger position with a smaller amount of capital. While it can magnify profits, it also increases the potential for significant losses. 2. Calculating leverage. You'll learn to calculate leverage based on your capital and position size. For instance, 10-to-1 leverage means you control 10 times the amount you're risking, which can significantly impact both gains and losses. Protect your capital and minimize losses. Capital preservation allows you to stay in the game longer, even after a losing streak. The strategies here emphasize protecting your account balance. Capital preservation. 1. Preserving your capital ensures you can continue trading through ups and downs. Effective capital management lets you maintain trading consistency, which is crucial for long-term success. Drawdown management. 1. A drawdown is a decline in your account's value due to consecutive losses. Managing drawdowns means developing strategies to avoid wiping out gains from previous successful trades and making it easier to recover. Techniques to reduce drawdowns include lowering risk per trade after a losing streak. Emotional control. 1. Emotions like fear and greed can lead to impulsive decisions that don't align with your strategy. Maintaining discipline is essential for sticking to your risk management plan. You will learn psychological techniques to detach emotions from trading decisions, which is key for maintaining consistency and preventing overtrading or revenge trading, trying to recover losses with impulsive trades. Review and adjust. Module 5, Trading Psychology. Cultivate a disciplined trading mindset. Importance of discipline. Discipline is essential for successful trading. It keeps traders from making impulsive choices driven by emotions like fear or excitement, which often lead to losses. Discipline ensures you adhere to a preset trading plan, minimizing the risk of straying into uncalculated trades. Setting goals. Setting achievable goals provides clear direction and focus. Goals, such as achieve a 2% portfolio growth per month or limit losses to 1% per trade, can keep you motivated and on track. Having realistic expectations helps prevent frustration and aligns you with long-term success. Creating a routine. A consistent trading routine establishes habits that reinforce discipline. It might include a set time to analyze the market, make trades, and review strategies. A structured routine helps you follow a plan rather than reacting emotionally to market fluctuations. Manage emotions and overcome psychological barriers. Recognizing emotions. Emotions like fear, greed, and anxiety are common in trading. Fear can prevent you from acting on a solid opportunity, while greed may lead to overtrading. Recognizing these emotions helps you pause, reassess, and make rational decisions. Emotional control techniques. Emotional control techniques like deep breathing, mindfulness, and meditation reduce stress and improve focus. Practicing these techniques regularly can help traders maintain calm under pressure, reducing the likelihood of emotional, impulsive trades. Dealing with losses. Losses are inevitable in trading. Learning to accept losses and analyzing them constructively builds resilience. Instead of letting a loss shake your confidence, view it as a learning opportunity. Evaluate the cause of the loss and adjust your strategy to prevent similar mistakes. Develop confidence in your trading decisions. Backtesting and strategy validation. Confidence comes from knowing your strategy works. Backtesting is a powerful tool where you simulate past market conditions to test your strategy's effectiveness. This validation process helps reinforce trust in your approach, so you can enter trades confidently. Positive reinforcement. Acknowledge and celebrate small successes, like achieving a profitable month or avoiding an emotional trade. Positive reinforcement builds self-assurance and can make a significant difference in your trading mindset, helping you stay committed to your strategies. Continuous learning. The Forex market constantly evolves, so continuous learning is vital. Staying updated on new trading techniques, economic events, and market analysis tools keeps your skills sharp, enhances confidence, and helps you make informed trading decisions. Risk management. Effective risk management means setting limits on potential losses, which helps you trade confidently. If you know you won't lose more than a certain amount per trade, the fear of losing won't dominate your decisions, allowing you to make calculated trades without hesitation. Practical exercises and activities. Journaling. A trading journal documents each trade, the rationale behind it, emotional states, and outcomes. Reviewing this journal regularly allows you to identify patterns in your behavior, strengths, and areas needing improvement. It also reveals your emotional responses to wins and losses, helping you fine-tune your mindset. Role-playing scenarios. Role-playing exercises simulate real trading situations, allowing you to practice emotional management in a low-stakes setting. For instance, you might simulate a rapid market drop and practice strategies to stay calm and follow your plan, reinforcing mental discipline. Group discussions. Group discussions with fellow traders offer support and shared experiences, reducing the sense of isolation and providing insights into how others manage their psychology. Sharing and learning from others' challenges can broaden your perspective and reveal new techniques for staying disciplined and emotionally balanced. Module 6: Advanced Trading Strategies. Section 1, Exploring Advanced Technical Strategies. Pattern Recognition. In this section, you'll delve into sophisticated chart patterns that experienced traders use to predict market behavior. You'll learn to identify patterns such as 1. Head and shoulders signals possible trend reversals, especially effective in spotting bearish market movements. 2. Double tops and bottoms, used to spot reversals. These patterns provide high probability entry and exit points. 3. Triangles, ascending, descending, and symmetrical. Triangles indicate periods of consolidation and signal a likely breakout direction. Divergence trading. Divergence trading focuses on the relationship between price and technical indicators, such as the RSI, Relative Strength Index, or MACD, Moving Average Convergence Divergence. You'll learn 1. Regular divergence, useful for spotting trend reversals when price and indicator diverge. 2. Hidden divergence, indicates trend continuation and is helpful for identifying retracements within an established trend. Multi-time frame analysis. Here, you'll learn the importance of observing multiple time frames for a fuller perspective on price trends. Key concepts include 1. Top-down analysis. Analyze from a higher time frame, for example, weekly, to a lower time frame, for example, hourly, for better trade positioning. Section 2. In-depth fundamental analysis. Macroeconomic analysis. In this section, you'll explore the broader economic factors that impact currency prices, such as 1. Interest rates and central bank policies. Understand how central bank interest rate decisions impact currency values and create trading opportunities. 2. GDP, employment data, and inflation. Learn to interpret economic data releases and forecast their potential impact on currency pairs. 3. Geopolitical events. Analyze how political events, trade tensions, and other global issues drive market volatility. Intermarket relationships. Here, you'll learn how different asset classes interact and impact Forex markets. For instance, 1. Commodity currencies. Learn how oil prices affect currencies like CAD, Canadian dollar, or AUD, Australian dollar. 2. Equity markets and safe haven currencies. Understand how stock market movements correlate with currencies like the USD and JPY. Seasonality and cycles. Some markets exhibit seasonal trends and recurring patterns. You'll learn how to 1. Identify seasonal patterns. Analyze which times of year currencies typically trend up or down. Section 3. Incorporating algorithmic trading and automated systems. Introduction to algorithmic trading. This section covers the essentials of automating trading processes. Key topics include 1. Types of trading algorithms. Learn about common types, such as trend following, ride established trends, mean reversion, trade against short-term extremes, and arbitrage, exploit price inefficiencies. Developing trading bots. You'll receive an introduction to programming basics for creating your own bots and tools like MetaTrader or Python. Topics include 1. Backtesting. Learn to test your bots against historical data for performance. 2. Optimization. Discover ways to adjust parameters and refine algorithms for maximum efficiency. Risk management in algorithmic trading. Automated systems require specialized risk controls. You'll learn how to 1. Set automated stop losses. Implement systems that automatically exit positions at predefined levels. 2. Position sizing algorithms. Calculate optimal trade sizes based on account balance, risk tolerance, and market conditions. Section 4. Tailoring strategies to fit your trading style. Personalized strategy development. Not all strategies suit every trader. In this section, you'll learn to assess your risk tolerance, available time, and financial goals to develop a strategy tailored to you. Hybrid strategies. Discover the power of combining technical and fundamental analysis. 1. Blending indicators and news. Find ways to merge technical indicators with macroeconomic events for greater trading accuracy. 2. Balancing time horizons. Apply both short and long-term perspectives to refine entry and exit decisions. Performance review and adaptation. To maintain profitability, traders need to adapt strategies over time. You'll learn. 1. Trade journaling. Keep detailed records of your trades to track performance and analyze mistakes. 2. Adjusting strategies. Use performance data to refine strategies based on market trends, reducing risks and maximizing returns. Interactive workshops and case studies. Real-world applications. Engage in hands-on workshops that apply the principles and strategies learned to live market data. Case studies of successful traders. Study the methods of seasoned traders, understanding what made their strategies effective and applying their insights to your trading. Module 7, Forex Options and Derivatives. In this advanced module, you'll explore Forex options and derivatives, powerful tools for both maximizing returns and controlling risks in the currency markets. This module is crafted to help you understand these complex instruments and to implement them in a way that supports your overall trading strategy. Understanding Forex options. Options are contracts that provide the right, but not the obligation, to buy or sell a currency pair at a specified price within a set time period. Here's how we break down their key components and strategies. Basics of options trading. 1. Strike price, the price at which the option holder can buy, call, or sell, put, the underlying asset. In Forex, it means the rate at which you can execute the option if favorable. 2. Expiration date, the last date on which the option can be exercised. You'll learn how to choose expiration dates strategically based on market trends and volatility. 3. Premium, the cost of purchasing the option. This fee is essential as it affects profitability. Understanding how premiums vary with volatility and time is crucial. Call and put options. 1. Call option gives the buyer the right to purchase a currency pair at the strike price, allowing for profit if the currency appreciates. 2. Put option provides the right to sell a currency pair at the strike price, useful if you expect depreciation. 3. Application in Forex. You'll learn to use call options to profit from currency strength and put options as a means to protect against devaluation, effectively creating a more versatile approach to currency speculation. Option strategies in Forex. 1. Straddles and strangles. These strategies involve buying both calls and puts to profit from significant currency movement in either direction. Straddles are ideal when a big move is expected but the direction is uncertain, while strangles are used when you anticipate even more volatility. Introduction to Forex derivatives. Derivatives like futures, forwards, and swaps are invaluable in Forex as they allow you to manage risk and speculate on price movements. In this section, you'll master their mechanics, advantages, and practical applications. Futures contracts. 1. A futures contract is an agreement to exchange a currency at a future date for a predetermined rate. These are standardized and traded on exchanges, offering transparency and liquidity. 2. Mechanics of futures. Learn about contract size, margin requirements, and how these contracts are marked to market daily. We'll cover using leverage wisely and the risks associated with it. 3. Applications in Forex. Futures are often used for speculation and as a hedging tool. You'll see how traders can use them to lock in currency rates, protecting themselves from fluctuations. Forwards. 1. Forward contracts are agreements between two parties to buy or sell a currency at a future date for a rate set today. They are customizable, making them suitable for specific business or investment needs. 2. Using hedging, forwards are especially useful for businesses needing to lock in exchange rates for future payments, mitigating risk from rate fluctuations. 3. Forex market application. You'll learn how traders can use forwards for speculation by predicting future rate changes, though they are more commonly used for hedging. Swaps. 1. Currency swaps allow parties to exchange principal and interest payments in one currency for equivalent payments in another. They're versatile tools for managing both currency and interest rate risk. 2. Interest rate management. Many swaps are structured to take advantage of interest rate differences between countries, allowing for favorable cash flow. Using derivatives for hedging. Derivatives are powerful for hedging against adverse currency movements, ensuring you can control risks without sacrificing growth potential. In this section, you'll learn to protect your portfolio effectively. Hedging strategies using derivatives. 1. Options for downside protection. By purchasing put options on a currency, you can hedge against losses if it depreciates. For example, if you hold assets in euros but are concerned about a decline, buying a euro put option can limit losses. 2. Futures and forwards for fixed rate protection. Locking in a currency rate for future needs using futures or forwards can be crucial for businesses with international obligations. This strategy allows for predictable costs regardless of currency fluctuations. 3. Swaps for interest rate risk. Swaps can help manage interest rate differences, enabling firms to switch between fixed and floating rates or to gain exposure to favorable rates in another currency. Managing currency risk. 1. Measuring exposure. Learn techniques to quantify your currency exposure, such as value at risk, VAR, and use these metrics to determine appropriate hedging levels. 2. Balanced hedging. Explore when it's better to hedge partially rather than fully, allowing for protection while leaving room for potential profits. 3. Real-world examples. Examine how multinational corporations use derivatives to safeguard earnings and the lessons traders can take from them. Case studies and practical applications. 1. Case Study 1. Hedging for importers and exporters. This example covers how companies importing goods from foreign markets use forwards and options to lock in exchange rates, safeguarding profit margins. 2. Case Study 2. Speculation versus hedging in emerging markets. We analyze how derivatives can be used for speculation in volatile markets while still offering hedging benefits. 3. Practical exercises. You'll apply what you've learned in simulated market conditions, giving you first-hand experience in using derivatives to manage risk and exploit market opportunities.